Okay, we're going to get started. Hi, everyone. Rod Crandall, U.S. Advisors. I'm the Chief Integration Officer. You are tuning into what we call our Coach's Corner. We do a Coach's Corner once per month. That would be on the third Thursday of each month. And so this is a series. Hopefully you've joined us before, and hopefully we'll see you again. So today we're really going to be discussing long-term care, but most specifically how to appropriately position that inside of the context of the financial plan. If you're on this call, you're very likely a wealth advisor. And as we work with mostly wealth advisors, and it's my opinion that implementing long-term care solutions is best done inside the context of the financial plan. And so we really love working with folks that are doing financial planning. And we're really hoping today to help you get closer to the fire to be able to incorporate this either into your practice at all, or maybe do a little bit better job incorporating it. I do find of all of the insurance that we can bring to bear for our clients, sometimes having the long-term care discussion can be one of the hardest things. And so hopefully in the next 45 minutes, you're going to hear from me and you're going to hear from John Thomas, one of our partners at SecureCare. If you're not familiar with SecureCare and their products in this space, you're going to be today. SecureCare happens to be one of my favorite companies in this space. They're in Minnesota. Many of you are as well. They're a mutual company, and they do a very good job with regard to servicing us and even the way they design products, etc. I won't steal too much of that info from John, but here's what we're really going to be talking about today. All right, so when we look at the actual plan for today, what we hope you walk away with is really give you some tools on how to have what I would consider to be a real conversation. What do I mean by that? If you just ask clients if they want long-term care insurance, the answer to that is no, and you've probably wasted your time asking them. They don't believe it's going to happen to them. They think it's too expensive. And if you're just going to ask, do you want it or not? The answer is no. So that's not going to be able to have a real conversation. The real conversation might have something to do with congratulations on your retirement goal, and look at my planning software. You're in the green. Isn't that beautiful? Would you like to have a conversation on some of the things that could derail this plan? Would you like me perhaps to stress test your portfolio to determine what the impact of a long-term care event might be? Even using the words long-term care, right? I don't hide from long-term care, but I don't believe we're really talking about long-term care. I believe if you need care, you're going to get the care that you need, and it's going to cost something. And if it costs something, you're going to be paying for it. If you're paying for it, you're going to pay full retail price plus. What is plus? It means you're going to have to advance money somewhere to be able to pay for that, and it might be coming from an account that is taxable. So it's really not long-term care protection that we're after. I believe you're going to get the care that you need. What we're after is retirement portfolio protection. Right? You've done a great job. You've saved money. You're in the green. You've got $10,000 a month, and if things go well, you're sitting pretty. What's the impact that a long-term care event could have on your income or your assets, and how do you feel about that? Right? And so inside of that, if we have that kind of conversation, we can make these recommendations consistent with the plan. I tell clients that I'm attempting to custom design a solution that will fit into your plan. And so we're going to talk a little bit more about how we do that and give you some tips. And we're going to spend a good bulk of this determining where does SecureCare shine inside of this conversation. Right? See, the product should come second or even last. The conversation comes first, but we have to identify who to talk to, and we have to determine how to talk to them. Then we bring in the solution, and SecureCare has some really great solutions. And if we have the right kind of conversation and we can pull together a great custom design product or solution, then it's like, well, how can we get this planning done on purpose or with intention? Right? Unless you're specifically on purpose have a plan for implementing this type of planning, it's going to be very difficult for you to do. So we're going to share a little bit of tips on how to do that and offer up some services, myself included. You certainly do not have to utilize me with clients, but many advisors do, where I become a member of their team and I can help steward these processes for you as well. So hopefully today you'll take away 1 or 2 or 3 actionable things that can help you. We're going to finalize the conversation today with what resources we have available. So we do have some wonderful resources that I think that you'll like that we'll highlight here today as well. All right, so as I've already alluded to, a lot of this starts with perspective. and that's the idea of that retirement portfolio protection. As it relates to this type of insurance planning, or really any insurance plan, you can get people really confused when you just show quotes. They go, man, I have like 20 options and I don't understand them. Well, I understand that, but the reality is you don't have 20 options, you have two. You can either take the risk that you've identified. One of us might need care and it might draw down our income and our assets. You can take that risk and accept it, right? Or you can transfer some of your money or some of your assets to transfer some of that risk. You see, if we could transfer risk at no cost, my conversations would last about 5 minutes. I just have people sign up. Here, sign this. Why? Because if I could transfer risk at no cost, I'd do it all day, every day. But the fact is in order for me to transfer risk, I have to pay something, right? And so when it comes down to it, I have two options. I can pay something and transfer risk, or I can pay nothing and keep risk. And I believe if we have conversations around that, it makes it a lot more palatable and they understand that a little bit better. And then if I don't like the risk and I don't like the cost, well, that's when we can have a real conversation and say, okay, what are our real options in order to do this? Okay, it's my belief that a lot of this protection is not only about the assets and the income, but it's about protecting the emotions of our clients, right? If we have a long-term care event, this is going to be the single worst event probably in that client's life. And even if it's not the worst event, it's not going to be good. And it's going to be an emotional burden and hardship for the family. And it's my belief that if our emotions are effectively in catastrophe and our math is in catastrophe, well, now we might as well put a magnifying glass in the sun and watch our yard go up in flame. And so what we can do as planners is we can help our clients think through this important matter, make sure we're touching their heart. What's important to you? What do you want to have happen? Okay. You have to touch the heart before you touch the mind. So often people go right into quotes. That's right into the mind. I guarantee you whatever quote you're showing is too expensive and don't show the quote. Now, I'm not saying that we can't show quotes or that we don't lead with quotes. We lead with conversations that touch the heart. Then we show the math and we compare notes. Okay. So I think that's the perspective. We need to make sure that our clients understand how we qualify, right? Generically speaking, what is this? It's contractually driven. Nearly all of our structures for what I would consider to be real long-term care plans require you to either qualify through a cognitive impairment or by demonstrating you need help with 2 or more of the 6 activities of daily living. I think it's very important to tell clients that up front because they don't really know what does it pay for. And by the way, do I have to be in a nursing home? No, you don't have to be in a nursing home. What you need to do is you need to demonstrate that you need help with 2 or more of the 6 activities of daily living, or you need to demonstrate that you have developed a cognitive impairment, and that will pull the trigger for your benefits. And you've got to pay close attention to your benefits because they're contractual language, and contractual language, all insurance is just a promise, and promises are not equal across the board. And that leads us into someone like SecureCare. Well, their promise, in my opinion, is about as good of a promise as you can get, not only because of their finances and their ratings, but their mutuality. And so we do need to pay attention. If we're going to transfer risk, we need to understand what kind of promise is happening. And so I bring a lot of attention to the contractual language, which is going to be very important for them to pay attention to. Now, if we know how we're going to qualify, the question becomes, what sort of structure should we custom design for you? Now, and today, we're not going to go deep on these structures. Okay, we're going to go deep on SecureCare structures. But generally speaking, I describe long-term care options as a 3 or 4 lane highway, depending upon what I might be bringing to a client and what might be appropriate to them. So you see on your screen, the 4 lane highway, in my words, are that we can do traditional long-term care, use it or lose it, pay as you go plan. We can do some sort of life insurance and long-term care combination plan that you continue to pay each year, or maybe you just pay for 10 years or 15 years, like one of SecureCare structures. Maybe you do a life insurance long-term care combination plan on a lump sum basis, and then maybe you do an annuity long-term care plan. And so I'll have a lot of advisors who will request a long-term care quote. Well, with complete respect, calling us and asking for a long-term care quote doesn't give us anywhere near what we need to be able to quote it. Right? Where would the funding dollars come from? Would they be qualified or non-qualified? Would the client be open to perhaps a lump sum funding or maybe a 10-pay funding? Right? If we got the high wage earners in their 40s and 50s, 10-pay can be great. I know John's going to share an example on that. And so the answer to all financial planning questions, and certainly insurance planning questions, are it depends, right? And so again, the idea here is to get in the right kind of person with the right kind of conversation, striking the right kind of tone to set the stage, to touch the heart before we touch the mind, then bring in the best products and designs that we have and ask people to make a decision operating in their own best interest based upon what their goals are for themselves, for their families, and for their legacy. Okay? You've got to make sure you ask some field underwriting questions. I really wouldn't quote anybody without asking them, are you as healthy as you look? Do we have any medication? Do you have any diagnoses recently that we need to pay attention to? And highlighting the difference between mortality and morbidity underwriting. They're fundamentally different, and some of the structures require both underwriting. And so certain ailments that are likely to kill us are okay for long-term care, but not so good for life insurance, and then vice versa. Okay, so just giving you a sneak peek that before you go quoting, have a great conversation, and hopefully I gave you a head start on doing that. So with that, what I'd like to do is I would like to turn it over to John Thomas. He's the Regional Sales Director at Thrivent, and he's going to spend the next 25 minutes or so discussing a little bit more about Thrivent himself, some of the designs that they have, and how he and they may be able to help you along with us here at US Advisors. So with that, John, are you out there ready for you to take control and step on up, my friend?
I'm here. Thank you, Rod. I really appreciate being able to join you all and share with you a little bit about SecureCare Financial and SecureCare, our competitive long-term care product. And Rod, you really set the stage for the conversation well, highlighting that it really is a conversation that starts with planning, starts with touching the heart before the mind, and hopefully, you know, as I know that you're an expert in really talking through and helping advisors build a long-term care plan for their client, right? And then hopefully you'll see in my presentation what the product looks like, what we offer, and how it really fits in that in fulfilling the aspect of that plan that you create for your client. So thrilled to be part of this conversation, Rod. So thank you for having me. As you mentioned, I'm going to talk a little bit about SecureCare, the product, and the time in the market. There's a unique opportunity right now with SecureCare, with SecureCare, our life insurance long-term care hybrid product. And I'm going to jump into the presentation, but highlight what that unique opportunity is. If you're not familiar with SecureCare Financial, we are Minnesota Life Insurance Company. Maybe you've heard of Minnesota Life. We've been around for 140 years, and we are a mutual company. And Rod, as you said, that's so important because we are selling promises, really, right? That's a policy that we promise, a contractual promise to deliver benefits that might be delivered 15, 20, 25 years in the future. And so you want a strong company that's been around for a long time that you know will deliver on the promise that you sell in the form of a long-term care policy. We're the 6th largest insurance company in the nation, and insurance is what we do. You know, several years ago, we expanded into Canada, and so the company felt like Minnesota Life didn't fully capture all of our business. You know, we weren't just selling products in Minnesota, and so we've branded under SecureCare Financial about 5 years ago as our, you know, international or global brand now that we're doing business in Canada, but we are still Minnesota Life Insurance Company. And when you buy a SecureCare policy, it's going to show up as Minnesota Life. So just a little bit of background there. We do have fantastic ratings, well rated, a top of the line Comdex at 96 out of 100. And so a company that you can certainly trust doing business with and recommending to your clients. Rod, as you said, I've been in the business for 15 years now, between a couple of carriers, and I landed at SecureCare Financial a few years ago. It was 4 years ago now, and one of the reasons is they were building out this life long-term care product, SecureCare, and they really had a vision that I believed in, being a strong competitive product in the market. They had a vision that was focused on transparency, guarantees, and competitive pricing. And so this news I have to share, we're excited to share that just January 23rd, not too long ago, we announced a decrease of 25% in all scenarios. So across the board with our SecureCare product, we announced a decrease of 25% in price. And so the opportunity from a product perspective really is that, this may be, and of course I can't say this with certainty, but this may be a time where you can recommend a solution that's going to be about as inexpensive as it may ever be, right? We're only getting healthier as a society. We're living longer, longevity is increasing, the blip with COVID aside, right? Medicine is advancing, and so we are planning for folks to live their senior years, plan for them to live longer and longer and longer, and the length and duration of elder care and long-term care is increasing. And so the costs of these contracts are increasing, but there's been somewhat of a couple of unique things that have come together for us as a company and then in the market. For us as a company, we were in the advisory business. We had a Securian Financial Network, which was about 1,200 agents or advisors across the country, and we decided to sell our advisory business. We decided, we were not really competitive in the market. We weren't competing with huge, advisor networks like your LPLs and Ameriprises and Ceteras, and so it wasn't a business for us that was growing. And so we decided to shift our focus back to our bread and butter, what we do well and what we're known for, and that's insurance. And the company has said that we are going to be competitive in life insurance, long-term care insurance, and annuity insurance, our top three focuses. And we really believe in the opportunity that long-term care insurance poses in the market, and the solution and really what it does for our consumers, our clients, right? And how it helps them plan and address this risk well. And so we are going to be in this long-term care space and continue to develop competitive products. In addition to that shift of focus for us, the market, if you think back a year ago, interest rates were incredibly low, right next to nothing. And then here we are now where interest rates have come up quite considerably. And so we've been able to adjust our hedging strategy as we have a fixed hedging strategy, and it's very interest rate sensitive. And so we've been able to adjust our strategy and get some better returns, and we've invested that back in the product. And so those things have come together and allowed us to decrease our price significantly with this 25% reduction. So we're thrilled. We've offered it in the compact states. The other states you see on the screen we'll be adding here shortly. We're going through the filing process, and then those states will have approval. I think by the summer you'll see us approved in the remaining states. For those of you that are familiar with some of the products in the market, this significant decrease has put us in a pretty competitive position. If you're thinking about how we compare in terms of the amount of benefit that we can offer benefit above Nationwide and Lincoln, two of our closer competitors, somewhere in the ballpark of 15 to 25%. And so a really significant impact. Now, what do clients get with SecureCare? And I mentioned guarantees and transparency, right? And we really take this Swiss Army knife approach that no matter what happens, there's a guaranteed whole life chassis that's going to provide a benefit for your client. If someone needs a long-term care, it's a long-term care policy. There's guaranteed long-term care benefit. If they pass away and need a death benefit, there is a death benefit. And that's really, return on investment. It's not a big life insurance policy, but if they make an investment and don't end up needing it for long-term care, that will be returned to their estate or portfolio, really returning to them what they invested, right? If they want my money back, there are liquidity options, ROP options, or if they're on an extended pay, as Rod mentioned, a 10 pay or a 15 pay. If they stop paying premiums for any reason, there's a guaranteed reduced benefit. So the policy is guaranteed not to lapse. Some of you probably have seen this infographic that's used for these life long-term care hybrid products, and ours is very similar. It's on a whole life chassis, and there are a couple of buckets. The first bucket is the life insurance part of the policy. So we'll take a quick example. Let's say a 60-year-old, we'll call her Sally. Sally has worked for state government her whole life. She's got a great pension. The pension is enough to create income to meet her lifestyle needs. and she's got a little bit other savings and qualified retirement. And she's been diligent in her savings, and maybe she has $600,000 that she's socked away in savings, right? And that 600,000, she recognizes, she wants to hold on to it, right? She recognizes it's there for emergencies. It's there to maybe pass down to her kids and grandkids, right? But without a long-term care plan, right? She needs, her lifestyle or income requires $10,000 a month in income. If she starts to need care and has to spend on care, right? That could be another $15,000 a month in additional income. Rod, you mentioned stress testing your retirement. Would her retirement assets be enough to handle a jump from 10 grand a month in income to 20 to 25, right? And so why not use what she has and reposition some of her assets to provide a hedge of protection against this significant risk, right? Because we know that medical costs and long-term care costs are the most significant risk to a successful retirement, right? For folks that are otherwise adequately prepared. And so she's got $600,000 in liquid savings, right? Let's take a portion of it. Maybe we reposition 100,000. And what is it going to create? Initially, it will create a death benefit of 136. That's that base policy, a base whole life policy. There's an extension that creates a total benefit pool. This scenario is 6 years of benefit. When she files a claim and needs care, she's going to turn on the income from this policy, and it's 136,000 initially. There is a 3% compound inflation rider added in this case, and we do add 3% inflation for a majority of the policies that we sell. But she turns on income. The base policy or the whole life policy would last for 2 years. Once it's exhausted, we pay out of an attached long-term care contract. In this case, it would last another 4 years, which creates that total long-term care benefit pool. Her $100,000 investment by her age 85, so 25 years of growth, is going to grow to a little over 900,000. In addition, there is an attached final expense policy, $10,000. If she uses the base whole life policy and burns through that initial 2 years, we'll still pay an additional $10,000, which I think of as really an attached final expense policy. Now, there are additional options. If we take that same 60-year-old Sally, she could pay it over 5 years. She could pay it over 7, 10, or even 15 years. And you can kind of see what this would look like paid out in different scenarios. Of course, we're funding it over a period of time, so the leverage you get is less. But really what to pay attention to is this IRR. And this is where these solutions, Securian and the other solutions, really are valuable, right, is the internal rate of return. Because this is a tax-free benefit as a qualified long-term care solution. The tax equivalent yield, and we used a 24% marginal tax rate to calculate this tax equivalent yield. So Sally, if she invested this $100,000 over 25 years, she'd have to earn at least 10.82% to match this 900,000 in benefit, right? And where this is powerful, I think, if you take Sally at 60, she's pre-retirement age, she's thinking about retiring in the next few years, she's probably not investing aggressively enough to earn a 10 or 11 or 12%. Sure, she could in the market, right? She could absolutely out earn 10%, but not on a guaranteed basis. And every aspect of this solution is guaranteed. It's guaranteed not to lapse. The long-term care benefit is guaranteed. This 3% compound growth is guaranteed. And when she needs care, she turns on this income, and Securian solution is indemnity, not a reimbursement benefit, but it's indemnity, so that monthly benefit pays no matter what the costs are. It really pays as income, and someone can use that income towards their long-term care costs, even if a spouse or family is providing care, no matter what the care looks like. And so it's really as close to an income benefit as Sally could get in terms of long-term care insurance solutions. So really, I think a powerful way to use the assets, hedge against this risk well. And if we've done that, maybe our other assets could be used a little bit differently. You know, we've hedged against this risk well, and so we can reimagine maybe not saving as much for health and medical care costs down the road. And as we get into, what does this look like in the market competitively? With this decrease, some of our primary competitors, Lincoln, MoneyGuard, Nationwide Care Matters, One America, those are solutions that we compare to most frequently and are most similar in what they deliver. A 60-year-old, this same Sally scenario with a 6-year benefit, 3% compound. Securian at this point in time is going to offer about $1,000 a month more benefit than the next best competitor, Lincoln Financial. If we take a male, the same scenario, male at 60, $100,000 single premium, same 6-year benefit, 3% compound. Securian's at 6,500 roughly versus 5,400 at Lincoln and 5,300 at Nationwide, and similar at One America. It really is a great place for us to be competitively, but also, as I mentioned, I think with the focus that Securian has on growing in the long-term care market today, and the way we've been able to reposition with interest rate changes, it's a unique time to move on a long-term care purchase today, at a time where the price is going to be as good, if not as good as you'll ever get it, I imagine.
Hey,
Now,
John, would you mind if I interrupt you? Could you please go back to that IRR page on page 8? I
sure
have
will.
a couple comments. I think this is the most important piece. When you talk about touching the heart and touching the mind, this one touches the mind. What I find in my practice is the person who needs to be, quote, sold is the wealth advisor. Okay. And so I loved what you said here, and I want to describe some of my language on what I look at. Just look at this very first one with no inflation protection. We have a day one and age 85 pool of funds of 567,000. You've got an internal rate of return of 6.43, in that case over 25 years. Now that, as you mentioned, what I call insurance companies is professional risk managers and professional money managers. So you have a professional risk manager, professional money manager called Securian, who has a very high rating. They're mutual, and they're offering you guaranteed, non-correlated, and income tax returns that are effectively equity returns, but with only company risk. And that 6.43% is a beautiful number. But what you're not showing, which is fine, you can only show so many numbers, is what's the return in year one? How long will it take you to turn 100,000 into 576, Mr. Advisor? Right? What about over 10 years? So what ends up happening is the internal rate of return early is much higher in these kind of products, and it goes less. Here's the beauty of it. We're not competing for assets in the market. We're just telling you that this asset could be performing as well as an equity-based product, but the money that goes into these accounts is very rarely coming from the market. It's coming from a bank account that isn't under management. Just now, people are starting to get increases in their bank account yields, but up until today, they've had virtually nothing. So it's a repositioning of a fixed asset that can give equity-like returns without equity exposure. And should this be an asset sleeve that your client ought to have? And if so, how much of it ought they have? So I just wanted to add that because I think the IRR is the most important piece mathematically to the whole thing.
Absolutely, Rod. No, that's brilliant and well put. And I love how you stated that. And you're absolutely right. These are most often funded with fixed assets. And as an advisor, if you're in this for the long game, right, your assets under management are far more protected. Use a fixed asset to create this hedge of protection, and that way, but the hope is that they're not coming for the invested assets down the road when they do need to pull that extra income, right?
Yep. Plus, what if it's happening in a down market? Yep.
Right. Yeah, this would be a tough time to be pulling that extra income.
Yeah.
Absolutely.
Thanks for letting me chime in.
No, thank you. Thank you. And then an additional piece I'll point out, and those of you that have a beat on long-term care and what's happening in the market and legislatively, a few years ago, Washington State passed the first public insurance, long-term care public insurance program, the Long-Term Care Trust Act, or what's now called the Washington CARES Act. And it is a mandatory, uncapped payroll tax for all earners in the state of Washington, all W-2 employees in the state of Washington. There is a mandatory 0.58% payroll tax collected on all earners in the state of Washington. So even folks living outside the state that are working within Washington are still having this tax collected. And this is creating a benefit pool that Washington is going to use for their residents to help contribute to their long-term care services. And so really what is happening is Washington has recognized the drain on their Medicaid system, right? That elder care, senior care costs are the biggest expense and biggest drain on Medicaid, state Medicaid systems. And so they needed a tax revenue, an additional tax revenue base to help mitigate some of those costs. It's not a substantial benefit. The benefits available to residents, to individuals in the state of Washington, was $36,500 total benefits for long-term care. As you can imagine, that's not a significant benefit, but enough to potentially mitigate some of those really short claims where someone goes to a facility and has a short claim, but it also gives them additional tax revenue base to address the Medicaid shortage. There are 12, actually now 13 other states considering similar legislation. So something that Washington did and other states may do is Washington allowed their employees to opt out of the tax. There was a one-time opt-out if they bought an individual long-term care policy. And so there was a massive run on long-term care insurance. Many of you probably heard of it or were involved or familiar. But what I'd like to mention is this is something that is going to start happening nationally as more states look at adding additional legislation. My state of Minnesota has legislation that they're putting forward. Pennsylvania actually has been added to the list. They've got Washington, very similar Washington legislation that they're going to vote on this next legislative cycle. California is also guessed to be next, and that would be a huge program. They're talking about an uncapped 2.5% tax in California. So the point of this is folks are going to be more aware of long-term care insurance. It's going to be coming up politically. It's going to be a topic that's front of mind for people. And so it's a great time to get ahead of the legislation, talk to folks about planning, why states are doing this, and that they don't want to be part of a substandard Medicaid program, but they want to have individual solution that it is going to provide the type of care that they actually want, which is home care in most cases, right? Now, to hit on a couple of prospect profiles, maybe Rod and I are touching your heart a little bit, and you're starting to understand the opportunity and really the need and the impact this type of plan can make on your client. From a product fit, most of our clients are somewhere between the age of 48 and 68 is really the bulk of the market. The product is available from 40 to 75. Think of more middle market to affluent folks, but there are even folks that are not quite middle market that could be a fit, especially your younger individuals. So folks that do have significant savings, whether or high income, adequately planning for retirement, and somewhat average to good health, right? That they don't have real chronic illness currently. They may have had a bypass or some surgery in the past, but if they're stable and average to good health, then maybe a fit for this type of solution. So I'll highlight quickly a couple of solid examples that I think may bring some folks to mind. We've talked a little bit about the affluent individual, right? The person that has adequate income, retirement, high savings. The other thing to point out about the affluent folks is a lot of their assets may be tied up either in investments, in tangible investments, maybe in property, in other tangible investments, and so they have limited liquidity. Liquidity for care may be a need because their assets are tied up. So why not use a solution like this to provide liquid income in addition to whatever income they have for their lifestyle. This quick example shows a 55-year-old repositioning $150,000 as a one-time premium, a 6-year benefit. At age 85, so 55 to 85, his benefit grows to $2 million, and that's monthly $26,000. The key with an indemnity policy is that those benefits are available to you regardless of your care costs. So this individual could receive the full $26,000 a month. It may be well above the cost of care, Anything above the cost of care can certainly be pocketed and used for other things. If family's providing the care, it can be repositioned to provide for family members as they're assisting in this care. We'll take a look at a younger prospect, so someone that is in their 40s. It is affordable, particularly if you're under 55. You can structure a monthly payment, just so you see what it looks like over a period of time. We'll have a 40-year-old that's going to fund it for 15 years, so until they're age 55. A minimal policy with 3% compound growth, roughly 171, we'll call it $172 a month. $172 a month over 15 years. At age 85, it's going to grow to $611,000, almost $612,000 of total benefit, roughly $7,800 a month. So with a pretty nominal investment, these days a little bit less than a car payment, probably, right? And we're planning and creating $600,000 available to contribute to our long-term care costs. If this younger prospect can fund it in a shorter period of time, they have options, whether it's a 10 pay at $2,700 a year, a 5 pay at almost $4,900 a year, or a single pay at $22,000, a one-time reposition of $22,000 in this scenario. So those younger individuals can certainly lock in while their health is good for a much lower premium. And then I'll highlight this one last example, Rod, our business prospects. We're starting to see a big rise in business owners funding a policy on themselves, particularly your small business, so your S Corps. So your S Corp owners can fund a policy on themselves and key employees within the business. And the way that SecureCare is set up as a qualified long-term care product, the long-term care portion of premium funds the long-term care costs of the contract directly. And that's important because it does allow the long-term care part of the policy to be deductible. So there is a portion of the premium that pays for the life insurance, the underlying life insurance policy, and then a portion for long-term care. And an S Corp owner could deduct a portion of premium that represents long-term care. They could also, as an individual or a business owner, if they have an HSA, they could also fund this same portion out of their HSA. There is an age-based limit that the IRS puts in place, and the IRS says that in 2023, for anyone from 61 to 70, the age-based limit is $4,770. And so we're doing quite a bit now on folks that are in their 62, 63, 64, and they're funding a policy over 10 years that might be $8,000 a month, $7-8 grand a month, or excuse me, $7-8 grand a year, $7-8 grand a year, and deducting as an S Corp owner, straight line deduction of this $4,770 as a deduction, so a little over 50% of their premium, or an HSA owner that's going to fund this $4,770 from their HSA and the remainder out of pocket. So Rod, I know you and the team are well versed in this tax deduction opportunity. So they're absolutely a great resource. Rod and Andrew and George and the team, a good resource to dive into the tax opportunities here, not just with S Corps, but C Corps and individuals as well. But Rod, I want to make sure I pass it back to you for your final comments and any questions that have come up.
That's beautiful. John, I really appreciate your time. Thank you. I find you to be a very good presenter, very clear. Hopefully you guys really understand. It's really about consideration. All of this stuff is really consideration. And we need to have the right kind of conversation to get to consideration. And if we can get that, what I find is that people are uncomfortable accepting the risk fully. If you really get down to it, what I find 8 times out of 10 is 2 things. They're uncomfortable with the risk and they don't want to pay for it. If I've got somebody in front of me on the Zoom screen, which happens all the time, and they're uncomfortable with the risk, but they don't want to pay for it, that means I'm having the right kind of conversation. Because at the end of the day, they don't have to pay for it, okay? They don't have to put insurance in place, but how do you feel about that? And what's important to you about your legacy, okay? And so at the end of the day, if we're gonna do this work right, we need to do it intentionally. And we need to, again, identify the right client, have the right kind of conversation. By having that conversation, we get the right kind of consideration. If we have the right kind of consideration, then we can get clients to implement. Our job above anything else is to motivate our clients to operate in their own best interest. But we have to steward an appropriate process to do that. It's also been my experience that if you integrate this type of planning into your practice, you might well see an increase in your gross dealer concession of maybe 10 to 30%. And I've seen it even higher. Over the last 20 years, I've worked pretty exclusively with wealth advisors, and we've had some pretty wonderful results together by incorporating this type of planning. So I want to share with you in the last few minutes that I have some of the tools that we have that can help facilitate doing that. Actually, that's not the screen I want. I want this screen. All right. So we have a form called Identifying Insurance Opportunities. I call it the I Got a Guy. We have 12 different identifications for people you can have different conversations with. We're going to focus on this retirement portfolio protection, and John already gave you a lot of this in his profile, right? So doesn't have to be 50 plus, but generically speaking, age 50 is what I think people really start thinking about this. They start empty nesting, they start really trying to retire. I think that's really the sweet spot. But for those that are high wage earners, I believe 40 and 45 is a very reasonable time. I'm 45 myself, and I told John in our prep that I'm about this close to buying Securian for himself or for myself and my wife. I have the same objection that every other client has. I'm too young and too healthy and I should wait. Well, maybe I waited long enough. I do happen to agree that with this 25% reduction, I got to tell you, I was pretty surprised to see a reduction that big. And I happen to believe with John's opinion that maybe it's the exact right time to do this right now, and it may never be priced better. Maybe it will be, maybe it won't, but I'm telling you, that's significant. So I think I'm going to end up taking action by the end of the year. Candidly, I'm waiting to see what kind of quarter I have, right? But I do think it's valuable for younger people to consider, especially if they're successful, especially if they're already maxing out their 401k. You're doing Roth conversions for them if that's the case. They're serious about planning. You know, people who are serious about planning and are great clients of ours, there's really one thing that's going to ruin their future, and it's long-term care. I'm not a scare tactic person, but we get a cognitive impairment today at $15,000 a month, which happens every day to somebody. 15 grand a month is going to crush many of our best clients. And it's not only going to crush them emotionally, it's going to crush them mathematically. It's going to crush your AUM mathematically, right? And then what happens when they need the care last year when the market's down 20% and now they're redeeming shares? Okay. Lazy assets. What I find is you have this kind of conversation, more AUM goes under management. Why? Because as an advisor, we think we know every dollar that the client has. And with full respect, oftentimes that's not the case. They have bank accounts and the bank accounts are sitting there. We ask them, what is the purpose of those accounts? They'll tell you, it's my emergency fund. It's my legacy account. It's my long-term care fund. Well, what kind of interest are you getting at the bank? It's a pretty lazy asset. What if we reposition that asset that you're earning 1% on? And we were able to guarantee you death benefit, return of premium, and huge long-term care leverage that has equity-like returns with professional money managers who are professional risk managers with non-correlated assets to the market, right? Is that an asset class that you should consider owning? Everyone's talking about insurance and what it costs. Stop doing that. We can create an asset class with complementary attributes to your other assets. Let's understand what that asset class looks like. Let's figure out whether you should have any of it. And if you should have any of it, in what design. And that's how we get this stuff done. So I would suggest that you use this, reach out to us to get this. We have a really wonderful, if I do say so myself, engaged planning conversation script. I hate the word script personally, but it's a talk track, okay? So if you have someone here and you're talking to them, you know, what risk are we really talking about? It's not the risk so much that we're trying to solve, it's the consequences. You may never need care, but if you do, and $15,000 a month shows up, what does that mean and how do you feel about that, right? You have personal consequences and financial consequences. Have you given that any thought, right? Who would provide your care? Do you think your daughter, have you talked to her about this, right? These are the soft side of things. The most important thing we do for a client is to help create a plan of care, not sell insurance. A client does not need insurance to have a plan of care, right? We have this conversation. What's important to you? I want a plan of care that first and foremost allows you to be safe in your home. It protects you physically and emotionally and your spouse, right? Really allows your family to supervise care, not provide the care, right? Would you rather have your spouse or your daughter or your son provide your care or supervise for your care, right? If we know what the plan is, we have to ask, who's going to pay for the care? Well, guess what? There's only a few ways that care can be paid. Medicare, very short term, very small amount, very short term. Medicaid, not our clients. In order to go on Medicaid, we have to spousally impoverish each other, right? It's not the spouse that needs care I'm concerned with, it's the spouse that doesn't need care that I'm concerned with. You can self-insure. Of course, self-insure isn't even true. You can't self-insure. There's no such thing. You can self-pay. And if you self-pay, should we stress test the portfolio? And how do you feel about the double dipping effect that occurs? And how do you feel about that potentially happening in a down market? Right? Then we can do long-term care insurance, transfer some of your money for some sort of structure. Then we can go into the ways that you qualify for the benefits, the main moving parts that are inside of those benefits, the reimbursement versus cash indemnity. I mean, to me, this is a beautiful track to systematically get people to understand, what are we talking about? What is my risk? What are my options? So if you like this, please reach out to us. John described tax deductibility. Depends on S Corp and C Corp and what age you are, what product you're on. Thrivent, a great player in the traditional long-term care space, has a nice 4-page tax deductibility guide that walks through a lot of that. We can make this available to you. The last thing I want to show you is something Lincoln put together. They call an asset identifier. They effectively promote using this for those clients who want to self-insure and say, okay, well, let's inventory the assets that you intend to use to self-insure. And then they're asking them to list those and effectively sign that says, we'll review plans, but we're going to self-insure. Now, in talking with advisors, many advisors are uncomfortable having a client sign something that says, we talked about it, but we're going to self-insure. Maybe you do, maybe you don't. I will tell you it's a great CYA for your file. We talked about this, especially if you're a CFP. But the real magic to this is, what are the assets they're going to list? Are they going to list the brokerage account? I doubt it. They're going to list the bank account. Okay, they're going to list the 2 bank accounts you don't even know about. Now that gives you the opportunity to reposition those bank accounts either into AUM or use that as a lazy asset to reposition into a Securian design or some other design, right? So that's effectively the last tool that I want to show you. Looks like my screen is blue on me for some reason. So let me stop showing this screen and see what's going on here. All right, I want to show you one last thing here, which is, where do we go from here? All right, stop showing. I apologize here, guys. Give me a second. All right, so if you liked what you hear, you can reach out to me, or you can reach out to Andrew or George. Whoever is working with you, we're happy to discuss another case with you. Our next Coach's Corner is scheduled for April 20th. If you haven't already checked out our toolbox, we have an insurance advisor toolbox that has all of our presentations, all of our scripts, all of our material. It's designed to be the single place where you need to go to intentionally integrate insurance into your practice. We do have contact info for Andrew and George and myself that I'm going to bring up here. And what we'll ask you is, again, reach out to us for your next case. Please join us in our next Coach's Corner. All my prepared remarks are done. If anyone out there does have any questions, I can hang around for a couple more minutes. I know John can, if anyone wants to come off a mute or go into the chat box if there's any questions. Otherwise, I'm going to hang out here for about a minute or so, and then we'll terminate the call if nobody has any questions or answers. Before I do that, John, send it back to you for any last minute comments from yourself.
Yes, thank you, Rod. No, it was a pleasure to be with you, and appreciate the invitation to join Coach's Corner here. I would just reiterate and amen what you said there towards the end. It absolutely is so imperative that we help our clients and families have a plan. Whether that plan ultimately ends up in an insurance purchase or not, you know, there are, I was just reading a study that nearly 60% of seniors that end up in a situation where they needed care did not have a conversation or a plan with their family beforehand. And so then you know, families are left to scramble and figure out what to do, right? And so that ultimately is a tough and terrible situation. So we want to encourage and have, you know, promote these tools to help folks have a conversation, have a plan. You know, hopefully it ultimately ends up in a financial plan or component, and that may include insurance, but they need a plan as a starting place. So just appreciate that mention, Rod, and I think that is so important.
Beautiful. Well, I appreciate it, and thank you so much for joining us. So with that, we appreciate you guys. I'll end this like I end our Monday morning calls. Let's all be good leaders for our clients. Let's help them, and let's drive revenue to our practices. So appreciate all of you, and look forward to talking with you next month on April 20th in our next Coach's Corner. Have a great day. We'll see you guys.